Well, this week, the Federal Reserve did raise interest rates by 3/4 of a percentage point. It doesn't sound like a whole lot, but it is in fact historic. News 12's Brian Armstrong finds out how the largest interest rate since 1994 could impact your wallet, your retirement, and your mortgage rates. Yes, tonight's Consumer News.
Touting recession, and the closest thing that you can think of was either COVID or 2008, and that doesn't give you the warm and fuzzies when you hear that word.
The Federal Reserve raised rates by 0.5 percentage point in May after record 40-year high inflation. The Fed then raised rates by another 0.75 percentage point, while the stock market also went into a bear market this week.
We can't continue on with 8% inflation rates. Even though that's really good for businesses, it's really terrible for the individuals who are actually spending the money.
John Vandergrift with Blue Ridge Wealth Planning says the Fed's goal is to stop inflation. This could lead to a recession, but that doesn't mean 2008 all over again.
A recession just means a slowing of the economy for an extended period of time, 2 quarters. When we look at it, we've got to know that this recession doesn't come out of nowhere. We're doing it on purpose, so it should not be as scary.
The impact also extends to being more expensive to borrow money. For example, if you're trying to get a mortgage, interest rates are much higher.
It looks way more than it has been, but we've been at historic rock bottom interest rates for a long time. You know, if you told somebody in the 80s that you could get a 5% interest rate, as terrible as that sounds today, they'd be crawling over people to get it.
Vandergrift advises stay the long-term course and remember you prepared for the market volatility.
As long as you've had a conversation with somebody about your risk and you've been able to dial that in appropriately, you shouldn't have to make any changes. You should just be able to weather it.
Brian Armstrong, News 12 Now.